Should you invest in a stocks and shares ISA? Well, numerous answers to this. One, in my professional opinion, if you are invested in a cash ISA, most certainly you should be invested in a stocks and shares ISA. Cash ISAs over the course of time have always underperformed the equity markets. Cash does not outperform the equities over the long term. I know since the financial crisis, you've been able to get ISAs 4, 5, 6%, etc. That is a thing of the past. The UK government is obviously lowering the base rate in the UK. Those rates are already starting to disappear. So if you're in a cash ISA, if you have the ability to take on equity weighted inside a portfolio, you should be investing in a stocks and shares ISA. If you have an investment timeline of 5, 10, 15, 20, 30 years, the empirical data suggests that you will massively outperform your cash ISA by having a stocks and shares ISA. Nothing wrong if you have a stocks and shares cash ISA. You might need that security net. That money might be very important to you. You might have no capacity for loss, but you should always be understanding with a financial advisor what your capacity for loss is and whether you should be using a stocks and shares ISA. Now, other ways to approach this question is, say somebody who is earning over £60,000 in the United Kingdom, you have the ability to top up your UK pension pot by up to £60,000 per annum, either through employer contributions or employee contributions or via yourself personally. Now, you should generally be maximizing contributions into your UK pension plan because it's more tax efficient than an ISA. And until 2027 April, UK pension pots do not form part of your estate for inheritance tax planning. However, an ISA, cash ISA or stocks and shares ISA, whilst it may be capital gains tax free, you get no income relief or tax relief on the way into that solution. And it also already forms part of your estate for inheritance tax planning. So it's very, very suitable for someone to be using a stocks and shares ISA, but typically speaking, in my professional opinion, you should be maximizing your annual pension contributions first. Now, one of the downsides of that, UK pensions cannot be touched until age 55, 57 from 2028. If you're 30 years old and you put money into your stocks and shares ISA, bang, you can take it out the next week. If you're using a modern platform, you can probably sell down the funds in 2 to 3 days, make a withdrawal a couple of days later. So it's very good from a cash flow perspective because you're not having to commit your money to the plan. If anyone has any questions, if you've got cash ISAs at the moment, you're thinking, what's the risk of going into stocks and shares ISA? How does it work? I feel uncertain. I feel worried about it. Get in touch below. Equally, if you're not contributing to UK pension pots at the moment, you're a naughty boy or a naughty girl, and if you can afford to, you should generally be making those contributions. It's one of the most tax efficient things you can do in the UK to keep your income below certain tax bands. I have videos on the channel about child benefit as well. The high income child benefit charge. If you earn more up to £80,000, or if you're £80,000 or more, you lose 100% of your child benefit. In that same situation at £80,000, if you were to contribute £20,001 per annum to your UK pension scheme, you would have £59,999, and then you would have zero child benefit charge to pay, and you would get to keep all the child benefit that your family receives. Anyway, I digress a little bit. As always, take care of UK pension assets and don't be afraid to get in touch. Have a conversation. You are not charged for telephone calls. You are not charged for Zoom calls. Let us put together a proper advice report on what we believe you should do. You can then make a decision on whether you believe the value of paying our fees and charges outweighs, the benefits outweigh the charges of paying for our advice. And as always, take care of UK pension assets.